Hi, this is Roger Balzer. Welcome to a special edition of our 2-Minute Tuesday. This is being taped on January 13th of 2016. Our title for this week is, What Do I Do Now? If you're seriously asking yourself or anyone else any version of that question, you have an investment strategy problem that needs to be fixed because it's probably too late to figure out what you should do in the middle of something like what we've been experiencing this year. The good news is that if you've done nothing, you're probably going to end up okay. I'm going to review the nuts and bolts behind that statement a little later. This first slide is from JP Morgan Asset Management. What this slide shows is the full year price return of the Standard & Poor's 500 going back to 1980. It's represented by the bars and the biggest peak to trough return in that same year represented by the red dots. Since nothing in life moves in a straight line, the red dots are inevitable for each year as there's always some give back off the S&P high each year. The average intra-year drop is around 14.2%. The average drop is 14.2%. The result, 27 of the past 35 years, darn near close to 80% of the time, the market has had a positive return for the calendar year. History is on the side of those investors who do not overreact. This year has been horrific. I get it. The S&P is down about 6% year to date. Furthermore, with the S&P down just a hair under 10% from its high, we're basically in correction territory, which is generally defined as a 10% drop from a previous high. This is our second correction since August. Most of the losses for this year can be attributed to concerns over China. The beginning of the week saw the blame fall squarely on the Chinese manufacturing report that came in just under expectations. The markets should not nosedive on minor misses. It was more like a policy misstep by China's central bank, and now I'll add that a renewed slide in China's currency, the yuan, contributed to it too. Another fear is that the speculation, based on common sense, is that China's leadership is losing control of the situation, and the markets today are not in a forgiving mood. And that's not all. There's other stuff. Yes, there is other stuff. A disappointing ISM manufacturing report and a continued drop in oil prices also soured the party. And also, there's a friction between Saudi Arabia and Iran that is continuing to increase. It's suppressing some conjecture that OPEC could agree on production curbs. North Korea successfully tested a hydrogen bomb, which is generating a new round of geopolitical uncertainties, as if there has been any geopolitical certainty in Korea since the 1950s. But it's not all doom and gloom. There are some positives from the economic front. Last week's 292,000 increase in non-farm payroll employment, together with the 50,000 upward revisions to the gains from earlier months, should put to rest any fears that the U.S. expansion is in jeopardy, even if fourth quarter GDP ends up being uninspiring. This job data shows that the U.S. economy is still growing. Someone on TV the other day speculated that the reasons wages are not growing is that discouraged workers are now re-entering the job market, which is keeping the supply of workers higher than demand just enough to keep wages flat. I can't attribute that to someone, but I agree with it. The bad news is people are not making a whole lot more money. The good news is wages drive inflation, and keeping inflation low will keep the Fed from having to raise interest rates too quickly. I think Fed patience is the key to extending this recovery expansion we've seen for the past several years. The ISM Services report signaled modest growth, which is good because we are now much more of a service-based economy than manufacturing. Auto sales moderated in December, but still set a record for 2015. I recently read that F-150 truck sales are a decent indicator to watch, and that's because only a small percentage of people buy F-150s to just cruise around in for looks in beast mode cowboy antics. The rest use them as actual functioning work vehicles to haul pipes, lumber, tools, compressors, dirt, and other building stuff, not golf clubs. Employment in construction, which would normally be impacted by nasty weather this time of the year, expanded at a vigorous pace in both November and December. That's good, but even if you strip out the construction jobs, employment still grew at a nice strong rate at the end of 15. If you take a look at this chart from Charles Sherry, you can see that employment has been on a steady pace up. And the upward revisions that I talked about a minute ago, during that same time, we saw the ISM manufacturing report signal a contraction in manufacturing. But the manufacturing sector added 8,000 jobs in December. What I want you to do is go back to August of last year. Remember, that was when the angst over China forced a swift correction in the U.S. markets, which we talked about, by the way. Remember, all the talking heads on TV saying, I managed da-da-da-da-da, and this China slowdown is going to hit the U.S. economy, and I know everything. I have my crystal ball out. Well, it turns out that U.S. job creation has improved, so I think you need to turn off CNBC or all those talking heads on TV. I can't wait because it turns out that even though China is the second largest economy, U.S. exports to China account for less than 1% of the U.S. GDP, and sales of S&P 500 companies to China account for just under 2% of revenues. It's noise that you're seeing that's happening out there. It's noise by itself. It's simply not enough to trigger an economic downturn here in the U.S. Now keep this in mind. None of this means that the volatility is behind us. Markets are going to continue to struggle every time the news comes out from Asia and around the world. But it should only matter to traders, not to you, because you have a good plan and a solid long-term investment strategy. That's right, isn't it? In my opinion, simplicity and consistency is the name of the game. Let the other guys go chasing their tails and let those big Wall Street firms profit off them rather than you. Also, don't let the talking heads on TV interfere with your plan and your investment strategy. You should not have to panic and ever say, what should I do now? You have a plan and you need to stick to it. Don't listen to the fools on TV now or ever. As an investor, you should never be unprepared for a major market disruption. If you're cringing at a 5% 5-day sell-off or what's amounted to a 10% correction off the high, you've misjudged your tolerance for risk. It does not mean you should panic. It just means you need to contact us and talk about it. No one likes losing money, but the markets have never grown in a straight line and they never will. Finally, if you bought a Powerball ticket, good luck. I think your chances in winning are about 1 in 292 million. I'd rather stick with an emotionless, logical, organized investment plan. Until next week, make it a great week. And if you have any questions, thoughts, concerns, or would like to just talk to us, please reach out to us at 440-934-3114 or shoot us an email, roger@balzerwealth.com.